Welcome, everyone. I really appreciate everybody joining us today for the tax webinar here. My name is Rob Holcomb, and I'm an extension educator with the University of Minnesota. I live in the southwestern part of the state, out on the prairie, and but I've been with the university now for 17, going on 18 years. And I head up all of the tax education programs for the university statewide. So, and I do quite a bit of tax workshop speaking. So, what we want to do here today, I guess when Dawn contacted me about doing this, we wanted to take about an hour and a half, and I'm going to allow plenty of time for questions. When I formulated the talk, I was really, income tax is so complex. I tried not to get a lot of the what I refer to as nitpicky topics, but tried to get more of a broad understanding of everything. So, so as we go through this, I'll periodically stop and we'll try to engage a little bit. And Don, I'll let you make the call if somebody's able to just chime in with the microphone where the size of the group where that would probably work. But let me go ahead and get started now. Anytime that you're doing income tax stuff, we always have this disclaimer that we're not giving legal advice. And as a licensed tax professional, I am not. I always have to watch that fine line between offering tax advice and stuff that you really ought to go to an attorney for. I am always a person that is always going to suggest to folks that you get help with filing your taxes. I know that TurboTax or a lot of the other off-the-shelf tax programs that you could buy at Walmart or Costco or Sam's. There's a lot of cost-effective programs out there, but I've been doing tax work since 1990. And I started out as a high school ag teacher before that. And all that time, I've seen a lot of self-prepared returns, and not very many of them are prepared correctly. It's something that you really ought to go. I know it costs a little bit of money to have somebody do that return, but I think you really do yourself a disservice if you try to self-prepare on that. Now, acknowledgement of where this material is coming from. The University of Minnesota is part of is a member of the Land Grant University Tax Education Foundation, or as I'll refer to it, the acronym is LGUTF. LGUTF puts out every year about a 700-page textbook that we utilize for our University of Minnesota tax school. It's a textbook that's used at 30 other schools nationwide. So it's a fairly well-recognized text for other land grant universities. And as well as, referring a lot of this information today came right from the IRS website. So agenda for today, looking at time and I, some of these things, I guess I've tried to rehearse times on this as best I could. I wanted to start off a little bit with a record keeping primer, just a little bit of food for thought on records and how those records integrate with getting ready for filing taxes. Then I also want to go through kind of an income tax primer. Talk about, what are the different types of income and why is that important? Also want to talk a little bit about depreciation. Also want to talk a little bit about information returns. Mostly we're talking W-2s and 1099s. Make sure that everybody understands when one of those things shows up, so that you understand what you need to do with that. I put COVID legislation and credits down here just because I may take about 3 or 4 minutes just to kind of recap some of the things that's happened since the beginning of the pandemic. It's really paramount. It seems like that's what I spend the vast majority of my time is dealing with COVID legislation. And then I want to wrap up with some tax planning tips because folks, I mean, today we're in approaching that mid-February time frame. Farm returns, a lot of farm returns get filed March 1. And so many of you may be in the process of getting your return filed right now. I know last week I pulled up tax software and I started working on the family return last week, and ran in. I did a first pass on it, and I've got my list of questions that I need to look up for my own return. So, but a lot of returns are going to be due March 1. The traditional deadline is going to be April 15th. So with that, let's just kind of attack this a little bit as we go, and just a little bit of word on records. Now, folks, as I mentioned, I've got some longevity in this business. And even when I was a high school ag teacher, I always had always had a fascination with records and analysis and income tax, and it's just the way I'm wired, which I know I'm weird, but that's just, some people, thank goodness, some people are wired that way to do this kind of work. But when you talk about farmers, record keeping ranks on the, if you were to rank a farmer's favorite job that they want to do, record keeping goes down to the bottom of the list. It's probably about one step ahead of cleaning the toilet at home. It just is not the thing that farmers want to do. That farmers want to be out working with the livestock, or scouting fields, planting, doing, they just inherently want to do something outside, and sitting at a desk and doing record keeping is just, it's not their thing. We all know this is a necessary part of the operation. It's something that we have to do, not only for the income tax portion of it, but one of the other aspects that I work with in my job is I work with farm analysis. And farm analysis, another fascinating part of the farming operation, is with the analysis. What we do is we look at the farming operation to determine, one, did we make money? And number two, if we didn't make money, or even if we did make money, what portions of the business are performing well, and what portions of the business could we possibly improve on? And that's really the whole purpose of analysis. Now, a lot of folks they want an analysis done because they need a balance sheet and an income statement to take to the lender, because they have to do that every year. I think that's probably the worst reason to do that. I think it's most important is to look at the profitability and the performance of the operation. Now, as far as computer software and record keeping goes, folks, for a good set of records, I will say this emphatically. You don't have to have a computer and computer software to do a good job of record keeping. Some of the most profitable operations I've worked with over my career kept a hand-kept record book. They didn't, in fact, they were resistant to go to computers, and it worked for them. But the most important thing is that you need to have a system. All right. And because oftentimes when in the past, when I've met with clients, we always do a meeting before the end of the year for fall tax planning. That's when we look at, all right, what do they have on the books for income and expense to date? And we might do this meeting like the middle of November or early November, somewhere in there. And where we look at where we are right now, and we look at anticipated income and anticipated expense between then and the end of the year. And then we start looking at prepayments and possibly some things we could do with depreciation to try and get them where they want to be from a tax bill standpoint. And I've had clients that bring me a report that was printed off at literally 3 o'clock in the morning the same day of the appointment. And when you put something together like that, there's a lot of mistakes. I mean, it's just inherently, it's going to be inherently mistake prone. Now, the other thing with records, and this is going to be easier with a computer system, I'm not going to recommend a records program over another records program, but a lot of folks use Quicken. It was actually originally designed as a personal checkbook program, but it can be adapted to a farming operation, and it's a rather inexpensive option in that regard. Many people have heard of QuickBooks. For a lot of folks, QuickBooks is probably overkill. Quicken would probably be a better job, and then there's some farm specific programs out there which again for small producers may be a little overwhelming. Anytime that you're doing a computer program, though, you want to make sure that you reconcile your books. And what reconciliation means is that you enter your stuff into the computer, and then you check your balances back to what went through the bank account. All you're doing is you're reconciling your bank account. All that's doing is it's proving that you got everything in your records that went through your checkbook. And that avoids a lot of errors. I've had colossal size errors on tax returns that we caught because the individual reconciled. Your record system should include a section for farm income and expense, and that should be separate from your personal stuff. I mean, we don't want in your record system, we don't want personal family living expense in with the farm stuff. We want to have the farm stuff separate. And we also want to have a section on capital purchases and sales. A good example of that would be, if you're a livestock producer and you've got breeding stock, if you sell some mama cows or you cull some ewes from the sheep operation, those get taxed differently from what the commodity sales get taxed at. So we keep those in a separate spot on that particular set of books. All right. So that's just a little bit of guidelines on that. If for those that are starting off, if you haven't done computer records in the past and you're interested in getting started with that, I would recommend Oklahoma State University out of Stillwater. They in the past they have had a chart of accounts that can be imported right into Quicken, and it's a farm chart of accounts, and that way you wouldn't have to set it up yourself. So I would definitely mark that down if you're needing to set that up. I can, and I'll have my email address up here later. Certainly shoot me an email and I can get you links to get at that stuff. Okay, tax refresher, and I did intend on getting that covered as far as the records go. Let's just go through and kind of do a tax refresher on this bit of information when we're talking about taxes. There's different types of income that we're going to have on the tax return. Now, ordinary farm income. What that's going to be coming from is if you've got raised animal sales. For instance, if you're selling lambs, or you're selling calves, or you sell corn or bean or soybeans, or some type of fruit and vegetable crop. All right, that's all going to be ordinary farm income. It's going to get reported on the Schedule F on the tax return. And the reason why we have to separate that out is, ordinary farm income is typically going to be subject to self-employment tax, and there's other things on the return that are not going to be. But your ordinary farm income is going to be your commodity sales, raised livestock, and other commodities. Now, Capital assets, and this is absolutely not the accountant's definition of capital assets. The way I define capital assets is anything that you buy that you typically would have to depreciate or look at depreciating. Examples of that might be machinery that you bought, breeding livestock. If you buy a bull, or if you bought a ram, or if you put up a building. You're not going to be able to just deduct those expenses typically on the Schedule F. Now, there's some exceptions to that. We'll talk about that later. But typically, you can't just deduct that on the Schedule F in the year that you buy it. It gets different tax treatment as far as that goes. And when you sell those assets, all right, machinery, breeding livestock, or a building, it gets different tax treatment upon the sale versus if you sold corn, beans, or raised stock. Now, when we sell capital assets, typically that's going to be taxed as depreciation recapture. And I've got a graph coming up later that will really explain what depreciation recapture is. But what it is, it's ordinary income, but we don't have to pay self-employment tax on it. And we'll get to self-employment tax here in just a moment. Now, on the return, you may have somebody in the household has an off-farm job. They're going to be getting a W-2. All right, and a W-2 is wage income, and that gets reported on the return. There's no self-employment tax due on that. Well, actually there is, but we don't have to worry about it on the return. On the W-2, there's typically going to be FICA and Medicare withholding that's shown on the W-2. That's the self-employment tax. All right, but it's taken out of the paycheck. The employer pays half and the employee pays half. And that wage income, when it goes on the return, is just going to get taxed at whatever tax rate that the taxpayer happens to be sitting in. All right, now let's talk a little bit about self-employment tax. All right, self-employment tax is going to be on business income. So if you're actively farming, that's going to be business income because you're in the trader business of farming. So it gets reported, that farm income and expense gets reported on Schedule F, and it's also going to be subject to self-employment tax. Now the raw calculation comes out to be 15.3%. There's actually a deduction that comes off there. You get to deduct half the self-employment tax, and that factors into that calculation. So it actually comes in at a little less than 15.3%, but that's where we start calculating it when we do that calculation. So any net income that you'd have on Schedule F, you're also going to be paying self-employment tax. So what we have, folks, is we got two different kinds of tax that we have to account for. We've got regular tax for the income, and then anything that coming from a trader business, we've got self-employment tax that gets tacked on there on top of everything else. So that's one of the points of talking about this. Now, if you happen to have, let's say that somebody had a rental property. Say they had a rental house, or they happen to have a field that they were renting to another farmer. All right, that income is the technical term for that is that's passive income. It's not income resulting from operating a trader business. If you're renting something out, typically it's not considered to be a trader business, so we don't pay self-employment tax on that. All right, and that's the reason we do that. Wage income, again, is going to have FICA and Medicare withholdings on that, so we don't have to worry about that either. So really, the only thing that we have to worry about paying self-employment tax on is that income that gets reported on Schedule F. Now, tax rates. Let's talk a little bit about tax rates here. Going back to late 2017, the Congress passed the Tax Cuts and Jobs Act, and that's the abbreviation TCGA. That was the probably the most significant tax reform that's been passed in this country. The last major bill that you find that did the same thing as the Tax Cuts and Jobs Act, you have to go back to 1983. So it's been a long time since that was passed. But what the Tax Cuts and Jobs Act did was it lowered all those rates. And if I look at this graph here, the blue line were the old rates, and the orange line is going to be the new rates. So essentially, what they did is they just lowered all the tax rates. Now, the other thing I want to point out here, we even talked about this at our income tax schools this year for tax professionals. The tax rates, whatever rate that you're in, whatever bracket that you're in, it's not just if you happen to be sitting in the 25% bracket, that doesn't mean that you pay 25% on all your income. What that means is that if we look at the chart here, excuse me, I'm going the wrong way. See, what we have is we've got a 10% bracket, and what you do is you fill up, the amount of income it takes to fill up that 10% bracket. Well, you pay 10% on that money, and then it jumps to a 13% bracket, and you pay 13% on the money that's in that bracket, and then it graduates. So if you happen to be sitting in a higher bracket, you only pay that higher rate on the amount of money that's in that bracket. So it doesn't mean that you pay that rate on everything. Okay, let me hit depreciation, and then let's open it up for some questions here a little bit. Now, what depreciation is, and I think depreciation is something that you really need to understand if you're a farm operator. Now, typically, when you buy machinery, breeding livestock, you put up a building. Drainage tile would be another thing that would fall into there. It could be a water system, any equipment that goes inside of a livestock facility. Okay, you're going to have to depreciate that. And what that means is that you can't take that deduction all in the year of purchase. You have to spread it out over a period of time. All right. Now, here's one thing that I've learned over the years is that the tax code is full of exceptions and more exceptions. Number of years ago, the Internal Revenue updated the tangible property regulations, or what I affectionately call the repair regulations. That allowed for items that you buy under a certain dollar amount. For most producers, that's $1,500. You can just deduct that on the Schedule F when you buy. If you bought a small piece of equipment or supplies or something that you normally would have to depreciate. So that gives us a lot of flexibility as far as the tangible property regulations, but there's still a number of things that we have to do that we buy where we're going to have to depreciate things out. Now, I want to show you a little bit about how depreciation works. And this is a major component of a farm tax return. Now, this is an old slide. All right. New machinery right now is 5-year property by statute. In other words, it gets depreciated over a 5-year period of time. Used machinery gets depreciated over 7. All right. So what I have here is I've got a tractor that was bought, and what I'm doing in the different years, I'm going to show you how much expense that we're going to get for each year. There's essentially 2 different methods that we can use with this. The top one is the maker's method, and I know folks are probably questioning this. They said, well, Rob, you got a 7-year asset and you're depreciating it over 8 years. What's that all about? Well, This is one of the weird rules with taxes. When you depreciate something for 7 years, you get a half-year depreciation in the first year, and you end up with a half-year depreciation that actually bleeds over into year 8 in this particular example. So with the MACRS method, which is modified accelerated cost recovery, I've got a chart that I can pull up, and it tells me for 7-year property, you take a percentage of the purchase price for each year, and that's where those numbers come from. On straight line, it's real simple. You just take that asset and you divide it by 7, and you see the numbers are all the same at the bottom of the chart for straight line depreciation. Years 2 through 7 are exactly the same, but we get half that number in year 1 and half that number in year 8. So yeah, it's weird that it takes 8 years to depreciate a 7-year property, but that's essentially how it works. Now, typically what a depreciation schedule is going to look like over time is something, and this is an abbreviated version of this. And again, this is an old slide, but it still illustrates what's going on. If I buy these assets in the different years, and I apply that depreciation over time, you see that if I take, say, like 2013 here, and you add up all the depreciation that was carrying over, because that depreciation is spreading that expense out. So that's what we have with the depreciation schedule, is as the farmer buys stuff and they depreciate it out, each year they're going to get some depreciation expense that they report as an expense on Schedule F, and that's what happens. Now, the following slide, what I'm illustrating here is you see what happened with the previous slide. We took all the depreciation for these assets. Now, later in the program, I'll talk a little bit about accelerated depreciation. That's where we can take a lot of, we can essentially write off that machinery or that breeding livestock or whatever. And if we do that all in the year of purchase, we get a big bang in that year of purchase for expense. But you notice going out over time, once we use it in the year of purchase, then there's no carryover, so we don't have any of that expense showing up down the road. And I think that's important for producers to understand how that works. If you write it off when you buy it, you don't get that carryover moving forward. All right. Do we have any questions, Don, or anything showing up in here? Now would probably be a good time to catch up on those.
No questions yet, Rob. I think you're covering everything pretty thoroughly.
Okay, all right. And I'm probably going to have to ratchet up a little. I knew the early part we were going to have to dive a little deeper into it, because if you don't explain it thoroughly, then it causes more confusion. So I hope everybody understands that. Well, I will continue to drive on here a little bit and possibly pick up the pace here a little bit. The like-kind exchanges. Now, what a like-kind exchange is, in the sense that I'm going to talk about here, is it's a tax-free exchange. And one thing the Tax Cuts and Jobs Act back in 2017 did is it did away with like-kind exchanges for personal property. Now, in layman's terms, what that means is that we can't do a tax-free exchange when we trade equipment anymore. What we used to be able to do, and I've got an example here. What we used to be able to do with the machinery trades is, if we traded it, and say I traded an old tractor for a new tractor, I would get an allowance for the old tractor when I traded that in, and then I had cash that I paid out of pocket to, in addition to the trade value of the item. And what I was able to do is I was able to do that exchange, and I didn't have to recognize any taxable income as a result of it. All right, I could do that exchange. I didn't have to recognize any income, and we just traded that, and the new money that I put to the asset, that would start to get depreciated. All right, those days are gone. Now what we have to do, this is what we have to do currently, is if you trade equipment, you have to recognize the trade-in value as income on the return, and then we show the total purchase price of that asset that we're buying to replace it, that gets depreciated at full price on the return. So there's some income that has to be recognized, but we get more depreciation on the tail end of this thing when we do those machinery trades, and that's been different since 2018. Okay, now I've mentioned depreciation recapture on several occasions in this talk. And what I want to do is I want to talk a little bit about what depreciation recapture is. This is a chart that it's kind of interesting here. I was out to dinner one night with one of our extension educators that teaches the Farm Estate Transfer Program, and he was wanting me to explain how this worked. I actually drew this out on a dinner napkin, and next thing I know, it showed up in a Farm Estate Transfer Program. But if we bought, let's say that we bought a tractor, we spent $10,000 on the tractor. All right, over the course of the time that we own the tractor, we took $5,000 worth of depreciation. So that was expense that we reported on Schedule F. All right, we still have $5,000 of basis left in that tractor. And if we were to sell that thing for, say, $20,000, all right, so what we have is we have a $20,000 sale, and I've still got $5,000 of basis in that asset. The $5,000 of gain that I have up until this line where there's a $10,000 purchase, that's going to be depreciation recapture. All right, it's ordinary income. We don't pay self-employment tax on that, but it's taxable income. All right, if we sell something that has a lot of basis in it, there's not going to be very much depreciation recapture. Now, the only way that we get capital gain treatment is good from the standpoint that it's a very favorable tax rate. It's a very low tax rate compared to ordinary income. But to get capital gain treatment, you have to sell that asset for more than what you bought it for originally. And anybody that's ever traded in machinery, you typically don't sell stuff for more than what you bought it for. Now, right now with inflation and everything, there's a possibility that could be happening. But in a normal economy, no, that's not going to happen. Okay, let's talk a little bit about information returns, and this is something that I think it's important for everybody to understand what's happening with information returns. There's a variety of information returns that you're going to receive. W-2s, of course, a W-2 is the wage statement that you're going to get if you have a job. Say if you have off-farm employment, you're going to receive that W-2, and that's going to report your wages, and then that consequently has to be reported on the tax return. Now, there's 1098s. Now, what a 1098 is a 1098 is typically going to report payments to you, such as interest. Another thing that's going to show up is educational expenses. Now, I have my youngest daughter is a college student, and when I was working on the family return earlier in the week, I was looking for, she gets a 1099 from the university that she attends, and essentially what it does is it shows, okay, here's the amount of tuition that she paid, and it also shows the amount of scholarships. It has a lot of the information that has to go on the tax return. So if you had a loan at a bank, interest that you paid on a farm loan is going to show up on a 1098. All right, so that's something that you put in an envelope, you take to the tax professional. Now, 1099s, which is where we want to spend most of our time, is those are going to be a variety of 1099s are going to reflect income that was received from the producer. So if you receive 1099s, If you get a 1099, it has to be reported on the tax return. One of the goals, and I guess when I first started doing taxes, the person that taught me how to do taxes he told me this, my job as the preparer was to assemble all the 1099s the client brought me. And you want to make sure that you put that information from the 1099s on the tax return so that the IRS computer can find it. All right. So depending on the type of 1099, that income has to be reported somewhere on the tax return. And if it doesn't get reported, then we end up getting an IRS notice, which typically what notices do is they ask the question, all right, we think that you should have reported this income, and they give you a chance to respond to it. Now, we just want to look at some pictures of some what these things are going to look like. And there's a lot of different styles of W-2s, but typically what a W-2 is going to have is there's going to have the wages are going to be reported up here. And if there's any federal withholding, that's going to be reported there. And if you're in a state with the state income tax, the state information is typically reported down at the bottom. And I apologize. This is a 2022. When I tried to find the image at IRS, I couldn't get it. They wouldn't give me a 2021. They only gave me a 2022. But the boxes are essentially the same. All right. So as far as a 1099, there's a number of different 1099s that you could potentially see. And you're going to receive a 1099 when you've received payment for something and the payor was responsible, or they had a responsibility to issue this 1099 to you. And a 1099 miscellaneous, you might receive that if you had rental income. Crop insurance proceeds are going to show up on here as well. Those are probably the two big things. Now, you might also have other income sometimes may show up on this. For instance, one thing that I remember a number of years ago, some folks on here may remember the tobacco buyout from about 20 years ago. When the tobacco buyout came out, the income from the tobacco buyout was actually put down as other income on box 3. All right, it didn't show up on a government 1099. Now, a couple of years ago, actually, excuse me. This was new for 2020. 2020. That was new for 2020. The 1099 NEC, which is non-employee compensation. If you happen to do custom work for, say, like a neighbor, say you took your tractor and you plow over and you did some field tillage work for a neighbor, or you did some custom harvesting for a neighbor, that's a case of where you might get a 1099 NEC. And that again has to be reported on the tax return. Your government payments are going to show up on a 1099-G. Now, this would be your 1099-G would be if you had any government payments coming from farm programs, and that the list of that gets pretty lengthy. So any government programs for farm program payments are going to show up on a 1099-G. Now, the ones coming from USDA, they've got their own style. I mean, this is a generic 1099-G, but it's still going to be reported in essentially the same manner. Okay, kind of to another break in the section, Don. Any more questions showing up?
No
don't
questions.
See any. Don't see any here. So, well, let's just take this was a slide that we did for our fall producer meetings that I robbed from that presentation. Let's just kind of look a little bit historically at, I'm shifting gears and want to talk just a little bit about COVID legislation. Now, since the beginning of the pandemic, there's been a number of legislative packages that have been passed. All right. And there's been a number of, we've had new terminology, we've had programs that have come into play, and what we find here is that I've literally, as a preparer and an educator, I found I've spent a majority of my time dealing with nuances of all these the legislation resulting from all this COVID stimulus packages. So we've had we've had the Family First, we've had the CARES Act, the PPP, healthcare enhancement. We had the CCA, and then we also had the American Rescue Plan, which was the most recent one. Now, out of all this legislation, the items that everybody is probably the most familiar with or have heard of, the PPP loans. Those were essentially a tax-free loan that you could get. It was a loan, but then you could apply for forgiveness, and it was essentially a tax-free event. Now, that said, there are IRS returns this year. If you've had forgiveness on a PPP loan, that does have to be reported on the tax return. It's more of a fill in the blanks as far as, yes, I had a loan for this amount of money and I got forgiveness. So that ends up getting reported under those circumstances. But I'm not going to get in, Don, I promise I'm not going to get into all this here. When we did our fall tax schools for practitioners this fall, I mean, we literally spent about 2 hours on the stuff on this slide, just going through all of the components of that. And we're not going to do that. I'm just going to point out that it's there. So the one thing on the returns though this year, and I've run into significant calls. This was also something when I mentioned I was working on my family return this week. This was something that came up as a question that I myself had to go back and research a little bit. There were the recovery rebate credits that were sent out in 2021. This was in part due to the COVID legislation. And that was the $1,400 per taxpayer, and also $1,400 per dependents. And the dependents were actually worked for the kids that were 17 and above, which in previous legislation they had been excluded. Now, as a taxpayer, you do need to go and look at how much money you did receive in 2021, because the payments in 2021 were based on the prior year. It's a case of somebody may not have received all the payments that were due to them. And when you do the 2021 return, if you didn't get the full payment on the return, you're able to say, all right, I didn't get the full payment for that. And that's what's going to trigger the payment of that remaining amount. So one thing, before you go to see your tax preparer, you do need to make sure, look either back in the bank account, or you should have gotten a letter from Internal Revenue saying that this is the amount of money that you received from this. And I will tell you, not all the letters from IRS were correct. That was one of the problems I ran into with my own return, is I got to that question and I had the letter from IRS that reported the amount of money, and I thought, this doesn't look right. And I checked with my wife, and she looked it up, and yeah, in fact, the number on the letter that we got was wrong. So that's something that you may want to kind of check on a little bit. But those rebate credits are not taxable. All right, they never were taxable, not going to be taxable. But if you didn't get your full amount when the return gets done for 2021, that's when you're going to get the remaining portion of that. Okay, let's move into one other component of the tax return. Excuse me here a moment, folks. Apologize for that. Ever talk that much, you got to wet it a little bit. The qualified business income is something that we have to be conscious in the farming operation, and I won't belabor this a great deal on this, but this was a deduction that came out of the 2017 legislation that was passed. It exists largely because corporations in the Tax Cuts and Jobs Act were given a flat tax rate. They for non-corporate entities, well, I'm sure this had to do with lobbyists and legislators and all kinds of things. But what they decided, well, the non-corporate entities need a little bit of a break too. So thus came this qualified business income deduction. Corporations can't, or C corporations can't do QBI. They're not eligible for QBI. Now, in the farming operation, and there's the calculations on this have been mind-boggling. I've written a lot of the stuff in the national textbooks over the last few years. This is really the topic that I consider myself a real expert on. But there's two different types of qualified business income deduction that you can get. It's one of those deductions is going to be from the money that's on your individual return. You're filing your farm income and expense on your Schedule F, and then that net, income minus expense on your Schedule F, that's going to be, in a lot of cases, your qualified business income. You'll get a 20% deduction from that. Now, that's one calculation. Now, the other calculation is for those that do business with a cooperative. All right, you may be a grain cooperative, a marketing cooperative, but if it's organized as a cooperative, all right, cooperatives can pass through qualified business income. If the co-op made money, that qualified business income gets allocated to the patrons, the farmer patrons, and that gets passed through on a 1099 PATR. So there's actually two deductions in play here. You got the deduction from your own income on your return, plus if you do business with a co-op, the co-op might give you more QBI that they allocate through on a 1099. All right. Now, the bottom of the slide, this is more information than what you need. There's income limitations for QBI. If you get above certain levels, then you have to have wages and basis and assets in order to get those qualifications. But frankly, let's not even worry about that. The point is, you got two ways of getting qualified business income. Now, if you do get if you do have sales from a co-op, what you do have to do is you do have to reduce your qualified business income by the lesser of 9% of the QBI or half the wages, because you're getting QBI coming from two different places. And people outside of farming were thinking that, when they were writing these laws, they thought, well, that's not really fair. So what there is there's a reduction that you have to take on that if you're selling to a co-op, because you're getting two deductions in that particular case. All right, and then what this gets reported on, I should have put this in the information, but it was kind of germane to the discussion that we had right here. This is another 1099 that you may receive, and you're only going to get this if you did business with a co-op. It's going to report your patronage dividends, which is box 1, and that's what that is. That's we'll just call that profit sharing. from the co-op that gets passed back to the patrons. The per unit retains is the amount of sales that you had from the co-op, and then box 7 just adds all that up, and that ends up being your qualified items here. The most important part of this is I wanted you to know what this looked like, because this is another 1099. If you did business with a co-op, you're going to get a 1099 that looks something like this, or it's going to be a substitute form, but it's going to say that 1099 PATR. Hang on to that. That's something that your tax professional has to have, because that's more income that has to be reported on the tax return. Now, this little more advanced topic, but I think it's important to talk about this. And this is something that your tax professional might be talking about. Let's say, for instance, that you were doing business with a co-op. Let's say you sold a commodity to the co-op, and then you sold commodity to a non-co-op. All right. And you got a mix there. All right. What we have to do then is we have to allocate between co-op sales and non-co-op sales. And what I've got here is, this is a spreadsheet that I use to allocate that out. This was a case of where, and I know these are big numbers, but it's the example I used for tax schools. If this was the total amount of income, and this was co-op sales and this was non-co-op sales, what we do is we've got a 65-35% split, and we allocate the expenses across that. So that way we can tell, all right, here's the QBI for the co-op sales, here's the QBI for the non-co-op sales. All right, so that's something that does need to happen. Dawn, any more questions? Nope.
Oh, no,
well,
no
I'm either doing a good job or I'm putting everybody to sleep. So
you're doing good.
Okay. All right. Depreciation changes. Let's and this is moving somewhat into the realm of fall tax planning, but I just need to point out that these are some options that are available. All right, Section 179 is a form of accelerated depreciation. Now, what we use this for is earlier in the program when we had the depreciation charts, and I said, well, if you write everything off in the year that you buy it, this is one of the methods of writing it off in the year that you buy it. Let's say, for instance, that you bought a plow, and you can opt to either depreciate that thing over the 5 or 7 years, or you can choose to take the whole thing as an expense in 2021, and you can elect this up until the time that you file the return. And you can go ahead and write that whole thing off, and it's going to give you more expense on your Schedule F. All right, so it would reduce your tax bill. The bad part is remember, if you take all the expense in 2021, you're not going to have any additional expense adding to any of your years moving down the line. If you take it all in year 1, there's no other deductions after that. All right, there's also bonus depreciation, or the technical term in the code is additional first year depreciation. This is also an accelerated method of depreciation that can be done. And again, if you had say for instance, a plow, and you wanted to take bonus on it, you immediately write the whole thing off, and you're done. The advantage that I find with 179 is that you could take, say for instance, if you bought a $10,000 plow and you wanted to write half of it off, you could take 179 on half the cost of the plow, and you could depreciate the remaining portion over the remaining life of the asset. With bonus, it's like an on-off switch. I mean, you either take it all or you have none. And what you do is you elect by class life in this particular case. So if you did it on machinery, you'd have to take it on all the machinery. Or if you did it on the breeding stock, you'd have to take it on all the breeding stock. But it's a yes or no switch flip that you have to do with that. Now, recovery periods, this is real simple. New machinery is 5-year property. Used machinery is 7-year property. This was changed with again with the Tax Cuts and Jobs Act. Now, fences are still 7-year property, and grain bins are still 7-year property as well. But let's just look at this. You know, the Tax Cuts and Jobs Act was passed in late 2017, was effective for 2018. So if I had a 17 new combine in 17, it was 7-year property. If I had that same new asset in 2021, it's going to be 5-year property. All right. So used equipment bought in 21 is going to be 7-year property. New equipment's going to be 5-year property. Okay, income averaging, and this is a technique, and it's this is something that only farmers can do. Now, what income averaging is where you can take, if you had a really good year and you wanted to take some of that income from the really good year and you want to spread it out over the prior 3 years, that's what income averaging allows you to do. And it gets filed in your tax return. It gets filed on a Schedule J. And what it does graphically, I think this pretty much explains everything. All right. So the chart here is reflecting the amount of income that we had in 18, 19, 20, and 21. We had a real good year. What we can do with income averaging is we've got a substantial amount of income in that upper bracket. All right. And what income averaging is going to allow us to do is we can take some of that excess money in 2021 and we can put that back into those prior years. And what we can do is we can utilize, you see that we have unused lower brackets in 18, 19, and 20. We've got open space between that top of that 12% bracket. And that allows us to take 22% money and get it taxed at 12% money by doing that income averaging. This does not affect self-employment tax. It's only for regular tax, but just be aware that that's available. Farmers are the only people that can do this. All right, again, this is only for farm income. Okay, let's go on with our miscellaneous section. I just wanted to touch on a few credits and some things to watch for and point out that some folks are probably seeing, saw in 2021 and what needs to happen with that. Now, the child tax credit. Now, there were, for anybody with children under 18 years of age, and this was something that changed. Child tax credit used to only work for kids under 17. With for 2021, it works. 17-year-olds were counted in that. So if you have a 17-year-old and younger, you're going to be eligible for child tax credit. They did these IRS did advanced payments this last year. So you started. A lot of folks may have been seeing advanced credits that showed up in a bank account, and that was done if they were if IRS had a bank account from a prior year. Otherwise, that was accrued on your system. But the credit that credit was accumulated over the course of 2021, and then it does have to be reconciled. In other words, the amount of the credit that you were eligible for 2021 gets calculated, and then you have to also write down the amount of advanced credit that you got, and in a perfect world it's going to equal, and there's nothing that happens. But in the event where somebody got more credit than what they were due, that is going to have to be paid back. Okay, earned income credit. This is a refundable credit. And folks, frankly, and I speak in terms of, especially in Indian country, this is probably the number one reason to file a tax return. When you have your tax return, the earned income credit is a refundable credit, meaning you might not owe any tax, but if you qualify for earned income credit, you'll end up getting a refund, even though there might not have been any tax due. There's general requirements that need to be met for earned income credit. You've got to have earned income. In other words, you got to have wage income, farm income, investment income. They raised this to $10,000. It has to be less than $10,000 of investment income, which a lot of folks are going to fall under that, me included. The tax return is going to cover 12 months. And what happens with earned income credit is it depends on the amount of income that you have on the return and also the number of qualifying children. The more qualifying children that you have, the higher earned income credit that you're eligible for. And it's more or less a floating scale. But this is something that is worth looking at, and and make sure that your tax preparer is running this through the software, because any of the software is going to calculate this for everybody. Okay, fall tax planning strategies. Let's move into this final thing. And I guess, Dawn, I saw something else pop up in the chat. Was there a question?
Nope. I just let folks know that at the end here, they can ask some questions and unmute.
Good. Okay. I saw the number pop up there, and I thought we might have had something. Okay, as far as fall tax planning strategies, now some of this stuff I'm going to talk about it now, but it was stuff that some of these items would have had to have been done before December 31st if you're a calendar year filer, but it still warrants talking about it a little bit. The first one is prepaying expenses, and we'll talk about that a little more in depth. What any of these strategies are mainly geared towards trying to lessen the tax bill is what they're doing. The one other thing to consider is retirement plan contributions. Now that may be for some and may not work for everybody, but it's something worth noting. If you do have a windfall year and you've got a tax bill, you can make retirement contributions, and those retirement contributions are deduction off of your taxes. So, IRA contributions, or there's a SEP, which is a self-employed pension plan. It's similar to an IRA, but they can put more money into it. And there's a variety of those retirement plans, but I've always encouraged folks to do that. Savings is always a good idea. And, if the cash flow will allow it, savings is always a good idea. And the benefit of doing these retirement plans is that you get some tax savings out of the deal, and it's still your money. So I always look at that really, really carefully. Deferral of income, talk a little bit about that in a subsequent slide. The possibly putting off livestock or crop sales. Accelerated depreciation is one thing that you might consider, because the accelerated depreciation, folks, you can decide that up until the time that you file the return. So even though we're into 2022, filing a 2021 return, at the time that you file the return, that's when you can decide, all right, gee, we might want to, if we had a new piece of machinery, we might want to write this thing off and see what it does for it. And also, if you're in an area where you might have received some crop insurance payments, you've got options there for deferral of those crop insurance payments. All right. So one of the paramount things that I always like to talk about is in tax planning is just looking at the tax rates. And as I mentioned earlier, the tax rate that you happen to pay is a blended rate. If you've got income into the 22% bracket, that doesn't mean that you're paying 22% on all income. You're going to fill up the 10% bracket first, and you'll pay 10% on that money. And then you'll fill up the 12% bracket and you'll pay 12% on that money. So you end up with a blended rate over time. What I like to oftentimes, my philosophy on tax rates is I like to pay attention to the tax rates and not necessarily the total tax bill. Because and I'll explain that here in just a moment. Like right now, the standard deduction. All right, now standard deduction is a deduction that you get on your return for this amount of money. If you're married and filing joint, that means you can have $25,100 worth of income that you're not going to pay tax on, regular tax on. All right. I encourage folks to try and have, especially in the farming operation, try to have at least that much income on your return, because if you don't utilize that 25,100, it goes away and you never get to use it again. It's kind of a use it or lose it type of provision. So I've seen a lot of folks over time, they would intentionally create a loss on the farm, and they would have, they would end up with zero tax. Well, the problem is this standard deduction is basically free money. So I always encourage everybody, try to have a certain amount of income on there. There's a sweet spot in there where it's going to be to the taxpayer's best advantage. Now, a couple words on prepayments. Now, again, this is something for next fall, for fall of 2022. We can't do anything more with this for 2021 because we're already into 2022. But in essence, farmers are allowed, if they are cash basis filers, and folks, in the 30 plus years of my tax career, I've only ever worked with 2 people that weren't cash basis filers. All right. It's not very common. I think it's a safe bet to say that, vast majority of folks are cash basis. If you're not sure, you're cash basis. But you can prepay up to 50% of your Schedule F expenses for the following year. Now, where this comes into play and where this works out very well is a lot of farmers may buy their seed in the fall for the next year. They also may buy fertilizer, chemicals, supplies, anything related to crop inputs. You can buy those things in the fall for the next spring's crop. And you're entitled, if you look at your Schedule F and you took a look at the total expense, cut that number in half, and that's what you're allowed to prepay. So if you're in a position where you need to manage the tax bill, oftentimes the best thing to do is just to prepay. There's financial benefit to doing that, because oftentimes if you're buying your crop inputs in the fall ahead of time, you're going to get a discount. And as far as the rationale for doing that, you're assuring yourself of supply, and you're setting your price. So those are business reasons for doing that. But that's real critical. But again, too late to do anything about that for 2021. Now, folks, if you happen to have been in a area where you receive some crop insurance, and I know that we could have some small vegetable producers on here that maybe have some NAP coverage, and if that's the case with crop insurance, If you were paid on something that you normally would have sold the following year, there's a very good chance that you're eligible to defer those insurance payments into the year where the sale would have normally occurred. All right, and that's part of this. That's an IRS code section 451 that I've got listed there. That's, forgive me, I pulled this slide from our tax preparer forum that we did, but that's the documentation of what allows that to happen. But so if you did get some crop insurance payments, you can elect to defer that, but you want to talk to your tax professional. That there's an election form that has to be filed on the return in order to make that happen. Now, one of the final things I want to talk about here a little bit is tax planning and rates. And this is a chart. This is a chart that I have been using. I guess I stole this from a former colleague at Tennessee Farm Bureau when I was working there back about 20 years ago. The chart here, it represents what your effective tax rate is. Now, this is assuming that we have, this is all self-employment income, wage income blended in with this, really not a good option. But the blue line is your income tax rate. All right, we got a little bit of a 10% bracket, then we got a 13% bracket, and then we jump to 22. The orange dotted line is your self-employment tax, 15.3% with adjustments. That goes all the way across, and then there is a cutoff where we hit a number out at like 148,000. Then that number goes down. The green line is just the combined amount. So if you have regular tax and the self-employment tax, so the green line is effectively at those various income levels is going to reflect what your effective tax rate is. So depending on where you're at, say if a person is out here at the say if a person is out here about $30,000 worth of income, they may want to remain right there. What they could do is they could, if this was a fall situation and they wanted to do some prepayments to get them down to here, well, you'd save a little bit of tax by doing that. So this chart just helps, especially at the fall tax planning. You look at where you're at on the chart, and you can kind of see from an accelerated depreciation standpoint and from a prepayment standpoint, if we generate more expense and get that net down to the certain levels, or in this break to this break is big. Going from the top of the hump down to here. So this is always important. I always print this thing off whenever I'm fall tax planning, because this helps visualize for producers, what they're effectively doing if they're doing some prepayments or deciding to do some accelerated depreciation. Don, with that, let's open this thing up for questions. And what I do want to do is while we're doing questions, I'll put my contact information up here. I've got my email address and my phone number. I will point out to everybody before we get some questions going that I do a lot of workshops, and I'm COVID, fortunately, our COVID numbers are dropping off like a rock, and I am planning on hitting the road and doing a lot of workshops starting in another couple weeks. So email this time of the year is probably the best way to catch up with me. And with that, Don, if there's anybody has any questions, we'll just open it up for everybody.